Welcome to another episode of Talking Trade. I'm Sandi Siegel, president of Emmy Day.
And I'm Ian Coxhead, University of Wisconsin-Madison. And our guest today is Professor Menzie Chinn, Professor of Economics and Public Affairs at UW-Madison, where, of course, he's in the Follette School of Public Affairs. Welcome, Menzie, to the show.
Thanks for having me, Ian and Sandi. It's a pleasure to be here. Thanks so much for having me.
Thanks, Menzie. Menzie is a specialist in international trade and finance with a particular depth of knowledge in East Asian affairs. And so, Menzie, it's been a very interesting time to be watching what's happening between the US and China. We've seen this week and earlier this year rounds of talks at the diplomatic level between China and the United States, which have been pretty acrimonious. The United States describing the new relationship with China as no longer based on engagement, but on competition. And in return, the Chinese Deputy Foreign Minister 2 days ago describing the relationship with the US as in equally hostile terms, saying that there's a whole of government and whole of society effort to bring China down. So my question to you is, with all of these issues in play, Taiwan, Hong Kong, Xinjiang, South China Sea, Chinese IT investors and more, are these kinds of political and ideological disputes likely to swamp good policymaking and economic regimes?
Well, that's an excellent question, and I've been pondering this set of issues for a while. I think I'm going to restrict myself to the sort of economic sphere, where I feel like I have a little bit more to say, and conceive of this as sort of a coming to a head of a long-standing set of processes. And I think that is, in the U.S., maybe ideological in part, a sort of disappointment with sort of mainstream thinking about increasing liberalization, the neoliberal order of international trade and finance benefiting us all, and as a consequence, we should be fully supportive or mostly supportive of the process. And then in China, over more than just the past few years that we associate with the Trump administration, I'd say at least 10 years, we've seen more and more this view that there's more importance accorded to controlling the economy and less to, let's say, liberalizing the economy along many sectors. And so those two forces in different parts, on different sides of the Pacific, are going to naturally lead to greater and greater, I'd say, disagreement on more and more areas of interest. And so maybe some of that was masked by the 4 years of the Trump administration. But what you see now is, I think, the collision of these two trends, where it's clear that we're cooperating less in certain policy areas. And so, Xinjiang, obviously, but we talk about things like intellectual property rights. It's been longstanding concern, but has come to the fore. And then issues about, Chinese ownership of American assets, American ownership of assets in China. I think in terms of China, where we're seeing that they're more willing to trade off, sort of not getting as many benefits and having more friction in order to keep control over their own economic prospects. And from the US perspective, more alarm at increasing presence of China in high technology areas.
Right. Interesting. For someone who's, lives in trade daily, and I feel this conflict, while we're more competitive now, as you say, and less cooperative, at the end of the day, I wonder how much it's really impacting trade and what the future holds in terms of our negotiation. What are your thoughts, Menzie, on the acceleration of the foreign investment that we're seeing in China? I know we've talked recently on this show how businesses are doing, instead of doing business with China, we're doing more and more in China and for China. And where is that going to leave us in terms of negotiating, our leverage and our trade negotiations in trying to help our economy? And how do you think that's going to affect trade and our negotiations?
Excellent question, and I think there's a wide degree of uncertainty in all these matters. The way I sort of divide things up is sort of in the short term, over the short term, we're going to see ups and downs, but the incentive is going to remain that, you know, we're big countries, both the U.S. and China, big in economic terms, big population, but big in economic terms. Trade is benefiting both countries in various dimensions because we're not equally good at producing all the things that each of us can produce. So trade is beneficial. We want access to their markets. They want access to our markets. So those forces will mean that there's going to be a lot of trade and increasing trade over time between the two countries. However, the nature of the relationships probably going to change. Certainly from the perspective of the Chinese, they're happy to take the foreign direct investment. They're happy to take the portfolio inflows. But if at any time they feel that the benefits are being outweighed by the costs, and the costs are going to be primarily, I think, what constraints are imposed upon what the political leadership can do, then that's going to give way. And, you know, FDI can move in a lot now, but contrary to popular opinion, it can move out quickly, because FDI is not necessarily build a factory. FDI is bought a company, and you know, despite the capital controls, you can get out somehow, either by just giving up or selling out to somebody in the same country. So you know, those sort of things can turn on the dime. For now, the U.S. has an interest in getting lots of goods from China, but we certainly have this growing consensus within Washington, D.C. Democrats, Republicans in general are saying we don't want a great Chinese presence in high technology industries, production of semiconductor chips. So you're going to see the nature of trade, I think, change to the extent that we are increasingly wary of having Chinese dependence on Chinese high technology, and possibly for national security concerns, Chinese having embedded structures, programs, so forth in the semiconductor chips they're selling to us. I mean, and like I say, this predates the Trump administration. Even as we were getting into the Trump administration, there's this process, CFIUS, you know, Committee on Foreign Investment in the U.S. has for 40 years been monitoring who can buy what firms in America, who can set up whatever factories in America on the basis of national security concerns. That was revamped in 2017, 2018 or so, that whole process. And along the way, of course, that process was partly directed at the Chinese. So both trade is being restricted on national security grounds, and so is foreign direct investment into the US is being increasingly restricted. I don't see any end to that process. And so that's going to be a continuing source of conflict. Now, that doesn't mean trade stops, because we export a lot of stuff to China, a lot of ag, a lot of like, you know, level industrial goods. China exports tons of consumer goods to the United States. Those things are not going to be deemed as national security concerns. So unless there's an incredible uplift of protectionist sentiment, and I think popular opinion is going the opposite direction, then you're not gonna see a big change in that aspect of trade, which in dollar terms is probably, you know, the biggest component.
So if we were to try to resolve the tensions over trade, plus these clear information about big increases in international investment in both directions, then it would be, you would say that the investment is mostly about seeking access to the other countries' market, even as supply chains are getting increasingly reshored back into the domestic economy.
You know, I haven't looked at the numbers closely. That would be my guess. That in terms of China, you know, you really want access to this enormous market, which is growing faster than any, you know, in dollar terms, it's got to be growing faster than any other single market. And you know, the concerns about increasing protection in China kind of cut both ways. You know, the Chinese could impose more restrictions on what foreign firms could do in China, but the Chinese could also, by way of many measures that we can't see clearly, you can only sort of see on the ground, could make it much harder to get stuff into China by trade. So you know, figuring out how these things are affecting foreign direct investment in China, you know, it's difficult to say what's going on. But my guess is it's the size of the market, the dynamic nature of that market, which drives a lot of FDI into the country. And whether that will continue clearly depends upon, you know, in some ways, how long China can sustain this rapid, relatively speaking, pace of growth.
Yeah.
Fascinating. It was such a pleasure having you, Menzie, and I'd love to have you back and talk about the billion-dollar question of how this might impact the Trump tariffs and the trade wars.
I'd love to come back. It would be speculation on my part. I've long given up prognosticating on the direction of politics and policy, yeah. But I can always talk about what would be the implications.
A wise decision, I think. Thank you again for joining us.
Thanks,
well,
man.
thank you for having me.
Terrific.
Thanks.
Yeah. See you again.
Hope so. Take care.